As we head into 2022, investors are confronted by a number of investment challenges. There are concerns about inflation and, of course, the ongoing effects of COVID. At the same time, the prospect of lower returns has been talked about for some time, but is now looking more likely. Regarding the investment environment, we foresee a wide range of potential outcomes and expect the next decade to look quite different from the last. This is both an opportunity and a threat. It presents an opportunity for us to add value for investors by navigating the series of setbacks ahead, but it'll require a different approach from that taken by many over the last decade. We are heading into a time when broad market exposure or passive investing could easily fall short of historical averages and may fail to meet absolute return objectives, making it difficult for investors to achieve their goals. In this sense, we don't expect an easy ride for the average investor. With elevated valuations and relatively low bond yields, the problem is quite clear. This problem can be summarised as how to adequately grow and protect capital in a lower return environment. So what's the answer? We don't think the solution is any one thing. That is, there's no silver bullet. There rarely is. We'll need to be a combination of strategies. At its core though, we think that the way forward is to ensure that portfolios are pointed to the right areas. Many of the most expensive assets currently sit in the largest components of the global equity indices, like the United States, which make up over 60% of the MSCI All Country World Index. But outside the US, there continues to be opportunities in sectors like financials and energy, while Chinese equities too are priced for stronger relative returns. For many years prior to COVID, inflation tended to be lower than many central bank targets. Demographics, technology, and the so-called sharing economy, Uber and Airbnb, all exerted downward pressure on prices. That changed with COVID. Huge amounts of stimulus, labour shortages, supply chain issues, and after an initial fall, rising energy prices. So it's been somewhat of a perfect storm. Omicron has elongated the process, but we expect the supply chain disruptions to eventually fade. Also, people will ultimately pivot back to experiences and travel. The effect of government and central bank stimulus should pass in time. A key watch point though are US labour force participation levels, which remain low. But again, we expect participation to improve as the cycle moves through. So while we don't expect hyperinflation to take hold, portfolios should be diversified and robust to a range of scenarios. In this sense too, it's important to not overpay for inflation protection. Energy exposure, for example, has been consistent with this theme. So, in summary, lower return expectations highlight the importance of targeting the most attractive assets and pivoting portfolios accordingly as the opportunity set evolves, while ensuring that portfolios remain robust to a range of scenarios on inflation and economic growth.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.